Welcome to Benson Financial, where we look at finances from a team's perspective. Do you think investing in individual stocks or spreading out your investment is more risky? With nearly $18 trillion invested in over 8,000 mutual funds are some of the safest investments out there. But what are mutual funds? A mutual fund is a professionally managed investment where investors' money is all put together and is put into stocks, bonds, money markets, and many different assets. Their goal is to make you the most money with the least risk possible. They give small investors the ability to invest in many different things rather than putting all of their money in only a few small assets. They have many different assets and you own a small part of it instead of the whole thing, and they're less risky because if one stock goes down, you still have all the other stocks to rely on. Many different types of mutual funds exist. These are the main ones. The first is an equity fund. It's mostly invested in stocks. Some of the investments are in stocks of similar sized companies. The smaller stocks are more risky, while the larger stocks are more secure. These funds have different categories based on what the goal of the fund is. Next is an index fund. Their goal is to try to beat the market. Managers buy stocks based on what the S&P 500 and the Dow Jones is doing. This makes them much cheaper to run, which means you make more money. These are also some of the safest of the mutual funds since they are based off of some of the largest funds already out there. Next is fixed income funds. These are invested in things that have a set return rate, therefore making you the same amount each month. They're invested in government and corporate bonds and other debts. The funds collect interest, then spread it out to their investors, and they also usually buy bonds at a cheaper price and then sell them at a profit. You do have to choose wisely when buying these funds because some are better than others. Balanced funds have different types of investments to reduce risk and just try to balance things out altogether. They invest to do what the investor wants them to do, and they want you to hit the like button. Next are money market funds. You probably heard about money market accounts that you can get at your bank. They're similar to money market funds, but money market funds are a secure, low-yield investment invested mostly in government and corporate bonds. Money market accounts let you invest into your bank. You give them your money so they can pay off their debts or whatever they need to pay, and they'll give you interest for borrowing that money. Next are income funds. They're similar to money market funds, but they create a higher yield to create a steady income for you. This is where their name comes from. It's to create you an income. They invest in the same things as a money market fund, which is the corporate bonds and the government bonds. Next are international funds. They invest in things in other countries. Some well-known American companies are actually foreign companies, like Holiday Inn and Trader Joe's. They can be safe or risky depending on what is happening in the country. Next are specialty funds. Many different types of funds exist, and you can invest in almost anything you want. This could be in a certain sector, a certain area, or even in your beliefs. So they don't invest in things that have to do with drugs or gambling or things like that. But it all depends what you want to invest in and what your goal for investing is. There are a few different ways you can make money from a mutual fund. The first is when the mutual fund receives a dividend from its stock and then it redistributes that money to you and makes you your profit. You can get paid with a check or have your earnings reinvested. The second way is when the fund company sells the stock, you get a portion of the increase. And the third way is when you sell your share of the mutual fund and the fund increases since you've owned it, you get that increase as well. Most of the money that you put into your retirement account goes into mutual funds. This money that you put into a retirement account is tax-free, and some employers have a matching program where whatever you put in, your employer will put in the same amount, and it's also done automatically so you don't have to deal with it. If you want to invest for your retirement, putting your money into a retirement account would be a good option since it does invest in mutual funds, and plus it's safe so you don't have to worry about losing your money and being stuck when you're retired. There are a couple ways to make sure you're picking the right mutual fund. The first way is to look at its history over the past decade or two. Make sure it's generally going up and make sure it's not doing anything suspicious over the past few decades. Also, compare it to similar mutual funds. Comparing it to the S&P 500 can be a good way to do it, and many mutual funds are actually trying to match the S&P 500 to begin with, so usually you don't have much to worry about. But make sure you do some research before you buy a mutual fund. And make sure it is diversified because, like I said at the beginning of the video, usually with a mutual fund, if one stock goes down, you have the rest to rely on, But if they're all invested in most of the same things and that whole industry starts to go down, then your whole investment goes down and you lose money. Usually 1 to 3% of your investment goes to pay for the people that are involved in running the fund. Some funds have no fees at all, but they all have different fee requirements. Few people are actually needed to run a mutual fund, and often a mutual fund is a small part of a larger investment company like Fidelity and Vanguard, among other companies. And they each have many different funds you can choose from. What are some advantages of mutual funds? Well, usually they're diversified. Usually this produces a better return, and they're safer. Also, they're easy to invest in, so rather than buying one stock, you could buy one mutual fund share and have a bunch of different stocks in your portfolio, you could say. It's also rather liquid too, so you can easily sell it, and it's not as easy to sell a stock or a security or whatever you would have bought otherwise. The cost of buying a single security with its fees, it costs a lot more than the fees of a mutual fund. Another advantage is that you get a professional manager. You don't have to manage your own portfolio. You have experienced people that buy and sell whatever it is that they're investing in, and you can choose a fund manager that invests how you like. Some disadvantages, though, are that there are changing returns. You may not always make what you expect, and there is no federal insurance in case your investment loses money. Another disadvantage is that you have to wait to invest. So since there are people always investing and uninvesting in mutual funds, these funds have to keep a lot of cash on hand so they can give these people their money back. So your money may be sitting around for a while until it actually gets invested and starts making you money. The cost is also a disadvantage too. You have to pay the fees for the managers, and this can cost quite a bit if your investment isn't making you any money. And also another disadvantage is that there could be bad investments. Sometimes the managers don't diversify as good as they should, so if the market drops, you could lose money. If you watched my 2020 goals video, I said that I wanted to invest in an index fund, and I would probably do that through Fidelity or Vanguard, depending which has the lower fees. But I do this because they're safe and easy investments, and they have a decent bit of growth. And right now would be a good time to invest in those anyway, since the market is down, so maybe you should go consider buying one as well. So let me know in the comments if a mutual fund is something that you would invest in, and leave a like to support the channel. Thanks for watching, and I'll see you in the next video.